Hi there, Brock VandenBerg, fund manager for Talamar Income Fund. Wanted to do a quick presentation using the slides from one of our vendors, and this vendor is Lightning Docs, and they're the ones that actually draft the loan documents for all of the loans that we do. Some of the advantages of Lightning Docs, if you're not familiar with them, is number one, it's an online portal. You take the information for the loan, you enter it into the portal, and then it spits out the loan documents that you need for your loan. Some of the advantages of using this platform and other similar type platforms is number one, they are drafted by our legal team that drafted the fund documentation. And so, number one, they're a good set of loan documents reviewed by one of the leading law firms nationwide in the private debt space. Number two, they're constantly updated. So they're constantly updating the set of docs based upon any changes here in California or nationwide on a state by state basis so that you remain compliant with all the rules and regulations nationwide with loan documents. And number three, or the third great thing about it is, if you have any issues with the loan over the course of the loan, they are drafted by Fortran Law. They do have a whole legal team that can assist you with any issues with your loan. So they already have insight into what their own loan documents state. So, it's just a natural transition into utilizing them for, any foreclosure issues or litigation issues related to the set of docs. And number four is that they're accepted industry wide. So big institutional lenders use them. When we go through our audit, they're comfortable and familiar with these sets of loan docs. So it's a great alignment for our fund to use Lightning Docs for drafting these loan documents. But one of the other great things that Fortra and Lightning Docs do is they provide insight into what they're seeing in the marketplace. So they provide insight into interest rates that are being charged nationwide, provide insight into kind of deal loan volume nationwide, and some other insights. And really, that's what I wanted to talk to you today and share some of these insights that they shared with us at the most recent Fortra at their Fortra conference. If you currently invest in trust deeds, or maybe you're a broker and you're brokering trust deeds, or you're a lender yourself, highly recommend using Lightning Docs. I would recommend reaching out to them if you want to learn more about them. Just go to lightningdocs.com or just search Lightning Docs, and you can contact somebody within their organization to learn more about it. So let's go ahead and get started. Again, I want to share the insights that I received at the Fortra conference. So what I'm going to present is a bunch of detailed information, again, in terms of interest rates, number of loans, where loans are being done. And the data set that they pulled from to provide us this information include the following three. Number one, they funded or put together 63,000 sets of docs in 2025. They funded over 30 billion in 2025 and over 87 billion since launching the platform in 2028. And they do about 3 billion in monthly loan volume at this point. So I think the data set is pretty deep and is pretty good set to rely upon to see kind of what's going on nationwide. Their analysis here, they're going to exclude loans between 50,000 and lower than smaller than 50,000 and greater than 5 million. They're also going to exclude rates that are below 4% and above 20%. So it gives a pretty good data set. I would suggest, though, and if I could for Lightning Docs to do this, is break out first and second or first position loans and loans that are in second, third, or plus position, because I think it all, again, will provide more detail on the types of loans, at least that we originate in first position. All right, so what this slide shows is bridge loan volumes by users. Essentially, they have about 216 users that meet their minimum threshold in usage. And what this does is compare sets of loan documents on a monthly basis to the prior year. So if you look here in February, you'll see a slight increase in the number of bridge loans, a set of documents that were drafted. If you were to go back further, you'd see a considerable increase in the amount of usage. But I think what we're seeing in the market right now is a definitive slowdown in the number of bridge loans that are being funded. Now, bridge loans include not only just your general bridge loans, so something on an existing asset, no value add, but also includes what you and me know as fix and flip loans, but what the industry considers is RTL, so residential transition loans. So this includes RTL loans. So, but what I do see is kind of a flattening in terms of total bridge loans that are being funded. I just think transaction volume remains pretty light industry wide. I also think these fix and flip and RTL loans are starting to slow down as the market slows down. So as these kind of prolific or consistent fix and flippers are finding it are holding properties longer to hold, they're just not doing as many units. Okay, what this slide shows is the bridge loans by rates and loan amount. So let's just focus on the average loan amount right now. So that's what's in orange. And what you've seen is a increase year to year of loan sizes. So here in February 2025, you're about 645,000. And in February 2026, you're about 712,000. Now, keep in mind, this is nationwide. So you're going to get states that have much lower loan amounts than what you have here in California. But I will say that if you were to use kind of the same thought process, we have seen a jump in loan sizes in the state of California, and actually pretty close to what you see as a percentage differential here on this chart. I think for some further slides down on this presentation will show you California and what the average loan rate is, or average loan size is. What I also want you to focus on is the average interest rate. And this is definitely what we've seen in the marketplace is the uh, um, decrease in rates of what we can charge. There's just more competition out there, especially amongst the institutional lenders. Also, what you're seeing nationwide is a balancing of what rates are for these types of loans. So historically, California has always had the lowest rates, primarily because number one, there's just the most amount of capital in California. Number two, I think it's considered one of the safest states to be lending in because, just that fact that we have a limited supply of land to build new housing, how difficult it is to bring new housing to the market. You really don't have that risk of an oversupply of housing that you might have in other markets like the Midwest, Texas, maybe Florida, maybe on the Northeast as well. So you take that away, and usually rates were lower in California than you would have nationwide. But what you're actually finding as institutional capital comes in, it is kind of location agnostic in a relative sense. I mean, I think if you look at some of these really small markets, you'll probably see a considerable higher, or can see a higher rate being charged. But what you're seeing nationwide generally is that differential, that difference between what California is and other markets is starting to equalize. All right. This chart just shows the average rate by certain, I guess, rate differential. So what you'll see here, starting at the right-hand side, 3.3% of loans were at 13% or higher. I think we really just want to look at this subsection of data. So what you're seeing here is 25% of the loans that were, or loan documents that were drafted. 25% were between 10 and 11%, 39%. So the largest percentage were between 9 and 10%, and then 17% sub 9%. And again, that's kind of what we're seeing in our loan origination is that you really need to be kind of in that mid 9, maybe high 9 percentage rate to really win these loans. Now, I do think we've kind of found a bottom right now. I don't think rates are really going much lower than what we're seeing right now in terms of general bridge loans. Maybe in the RTL or fix and flip space, you are seeing still some rate compression just because, there's just so much institutional capital kind of chasing these fix and flip loans. What you show here, or what we see here, is the bridge loans by state. So California still remains number one in terms of total loan documents drafted. Second is Florida. Third is Texas, New Jersey, and North Carolina. Now, Texas in 2026 year to date. So this shows everything that was done in 2025, but year to date, Texas has jumped Florida. Ohio made a considerable jump from what is it, one, two, three, four, nine, spot nine, all the way up to spot four. So you're seeing some adjustments on where loans are being done. But again, overwhelmingly, at least on the Lightning Docs platform, California is the number one state. Uh, what this what this slide shows is most active bridge loan by county. So Los Angeles County again is the most number of loan documents are being drafted in Los Angeles, with San Diego in second position, and then Cook County in Illinois in third position. Now you did see again Dallas, Texas make a quite a big leap. Miami stayed in the same position, but Cook County, Illinois did see a decrease. So California, the two big California markets really that we're focused on, and specifically that we're actually lending in, are San Diego and Los Angeles. What this chart shows here is top bridge market by activity, and what how that differs from what we the prior slide is that it actually shows interest rates as well. And I want to find something to show you that's kind of something that's fascinating here is that number one, Los Angeles had an average rate in December of 2025, about 10.34%. And then had a slight increase to February 2026 to 10.45%, which I thought was really interesting that you actually had an increase in Los Angeles. Now, I think this subset is a little, in terms of dates, a little close together. I'd like to see what it was maybe a prior year of February 2025, but you're starting to see you saw a slight increase there. Now, I think there is some concern about where the housing market is going in Los Angeles, but we'll see what happens out here the next 12 months. San Diego had an average rate of 9.94%, again, consistent with what we're seeing within our fund in December 2025. We saw a slight drop in January, and then in February, a slight increase. Again, it's hard to tell why that slight increase happened, but it does at least give you a snapshot of where rates are currently in San Diego for the types of loans that we're funding. Now, as I mentioned earlier, typically California always had lower rates than states outside than other states, especially kind of Texas and Florida. But what you're seeing again is you're starting to see this equilibrium occurring in these states of like California, Texas, and Florida. So take it for example here, Miami-Dade County in Florida. You actually saw rates lower than what you would have in both Los Angeles and San Diego, which honestly is a shocker. And the reason I think that's happening is that I think more money is going into Texas and Florida simply because there's less regulation in lending in both these states. So when you have more money, it becomes more competitive and rates go down. In California, not only obviously you have to have the right licensing in place, there are other risk factors of lending in California, and you're seeing that in the rates that are being charged. Except for the one county that I thought was an outlier, which is the bubble video, or the bubble here is blocking, is Santa Clara County, which had a rate of 9.21% in December and 8.95% in February. Now, I cannot explain why, other than probably just the sheer amount of capital available to be lending at an individual level in Santa Clara County. And so, I don't think institutional lenders at a mass scale are at these rates for the type of loans that are being drafted with Lightning Docs. That's interesting. But I did want to kind of highlight, for example, Harris, Texas, where rates right now are, again, below what you would have in Los Angeles, and 9.76 below what you would both have in Los Angeles and San Diego. So that's just something to continue to keep our eye on. Let's just see if rates in Texas and Florida still continue to drop below what the average rate in some of these California markets are. What this chart shows is a map of some of the activity for private lending nationwide. You'll obviously notice that much of it's done on both coasts. Vast majority here in San Diego and Los Angeles, with the Bay Area as another hotspot. And then you get up to Washington, up in Seattle, Portland, and surrounding markets. Get over to Texas, you see the three main lending markets, and then down in Florida as well. I'm going to go ahead and skip over DSCR. Simply, these are more like 30-year rental loans that Lightning Docs also drafts. Other than what's interesting is that they've seen a considerable jump in the number of DSCR loans that are being written right now. And what I believe, and I'd be interested to see if this is true over the next 12 months, is that I think a lot of fix and flippers who are unable to get the pricing that they had originally underwritten on their projects are actually shifting these assets into long-term rental loans and holding them as long-term rentals to see if values start to go up on some of the projects that they have recently funded. But again, pure speculation. I don't have any insight on that. I'm just trying to understand why there's such a considerable jump in the number of DSCR loans that are being drafted and that are being written. And I'm going to go ahead and skip over the rest of these chart or the rest of these slides as they don't really have much to do with what we're doing. So hopefully this gave you some insight into what I'm seeing in the marketplace, but kind of backed up by a third party who is definitely involved at a much larger scale in the private debt space. If you're interested in learning more about Lightning Docs, I give them 2 thumbs up. I think they're a great product. We really enjoy working with their team. We feel that the docs that they provide, they make it very efficient, cost effective, and good set of loan documents. So reach out to them. If you like this video, give it a thumbs up. Be sure to follow us on our YouTube channel. And if you have any comments or questions, feel free to put it in the comments section on where you're watching this video, and I'd be more than happy to respond. But thanks for watching.